Hello guys, Jeff here. Welcome to the Intelligent Investor. In today's video, we are going to talk about DVR shares or Differential Voting Rights Shares. DVR shares or Differential Voting Rights Shares are a class of shares that entitle its holders to benefits of regular equity shares such as dividends and capital appreciation. However, the key difference between DVR shares or differential voting rights and ordinary shares lies in voting rights. DVR shares typically have fewer voting rights than ordinary shares. Here are the key advantages associated with DVR shares. Number one, higher dividends. To compensate for the lower voting rights, companies typically offer higher dividends for DVR shares. This can be attractive for income-focused investors. The second advantage of DVR shares is a lower price. Due to the lower voting rights, DVR shares typically trade at a discount to regular shares. This can be a good opportunity for investors looking for value. The third advantage of owning DVR shares is liquidity. DVR shares, just like ordinary shares, are listed on stock exchanges, and this offers liquidity. Now let us look at some of the disadvantages associated with DVR shares. Number one, lower voting rights. This is the main drawback of DVR shares. Lower voting rights means that DVR shareholders typically have less say in important company decisions such as electing board members and voting on mergers and acquisitions. The third disadvantage associated with DVR shares is volatility. DVR shares are more volatile than regular or ordinary shares. This is especially so in market downturns. Another disadvantage of DVR shares is limited availability. Not all companies offer DVR shares. DVR shares are available in some countries and on some industries only. Another disadvantage associated with DVR shares is negative perception. The use of DVR shares by investors can lead some investors to have a negative view of DVR shares due to limited transparency and limited control. Another disadvantage associated with DVR shares is negative perception. The use of DVR shares can be viewed negatively by some investors due to issues with control and transparency. Now let us look at who should buy DVR shares. Number one, income investors. If your priority is a higher income, DVR shares are a good choice for you because of higher dividends. Number two, value investors. If you believe that value investors. If you believe that DVR shares are trading at a discount and a company is undervalued, DVR shares are a very attractive option. Number three, long-term investors. DVR shares can be a good investment for long-term investors who are less concerned with voting rights and more concerned with dividends and capital appreciation. Before investing in DVR shares, conduct a thorough analysis on the company and its financial strength. Also, it is important to know how the voting rights. Also, it is important to understand how the voting structure differs from the regular ordinary shares in a company. Also, you should consider your investment goals and risk tolerance before making any investment decision. Okay guys, that's DVR shares or differential voting rights shares in a nutshell. In our previous videos, we have looked at ordinary shares and preference shares. If you have not watched these videos, kindly go and watch them. Thank you for watching. I hope you have liked this video. Kindly subscribe.